everybody. Thank you for joining our webinar today. So just a preface, for many of you, this review today may actually be pretty basic and probably things that you already have understanding of. The reason why Brian and I wanted to have this webinar today is actually due to finding a shocking amount of managers that actually don't have a full understanding of how to read and break down a profit and loss statement, or even have basic understanding of where this data is coming from and how to interpret the data. So we really hope today that we are able to show today to give everyone basic understanding how to read your income statement and have just basic understanding of the breakdown of it. My name is Sydney Lynn, and I am joined today with my co-partner, Brian McCaig. Brian and I are client advisor at RSI. You'll see our contact information on the screen, and we'll also be providing it again at the end of the webinar if you guys have any other further questions for us. We're hoping to keep this webinar today at about 35 minutes for those of you that are planning out the day, and we'll try and leave some extra time at the end of it for some Q&A as well. So let's get started. So today we're going to first be helping you understand how to actually read your profit and loss top to bottom. We're also going to go over best practices on how to use your weekly profit and loss statements to maximize your profitability and find actionable items. And finally, how to get your management team to really take ownership and be accountable to the financial results and have them actually be reporting to you what those results are versus you asking questions. So with that, I think it's a perfect time, Brian, for our first poll question. What do you say?
Let's do it. Let's get to our first poll question. And actually, before we do, I want to remind everybody that there is a Q&A section of the webinar. So go ahead and get your live questions in as well. Like Sydney said, we're going to try to leave some time at the end of this presentation to address those. And if there's any questions that we don't get a chance to address, as always, we'll reach out to you directly after the webinar is over with the answers there. So that being said, let's get into our first poll question. And the question is, how frequently do you at this point review your profit and loss statement? You may say daily, weekly, monthly, or every period, quarterly, or never. All right, I'm gonna give everybody about 20 seconds to get this in, and then like usual, I will share the results and we'll talk about those results at the end too. And I see a ton of results coming in, so thank you for getting those.
Let's hope no one says never, but I wouldn't be surprised. I've actually had clients in the past that have never looked at their profit and loss. So
yeah, and hopefully, I hope more that by the end of this presentation, someone who may have said never understands the importance and would not answer that way afterwards.
That's our goal, right?
That's our goal. Okay, it looks like everybody got a chance to get it in. I'm going to end the polling. And the survey says, you should be able to see it up on your screen, the majority of responses were weekly, which is great. A lot of people said monthly and period. And Sydney, I'm sorry to say there was somebody or some small amount of people who said never. So like I said, hopefully that changes after this, right?
Well, I think that's fabulous. Thanks for being honest, and hopefully we'll convince you to do so moving forward.
All right. Well, let's get into the first part of your P&L, which is the sales, understanding your sales. And I want to start with the difference between gross sales and net sales. And this conversation comes up a lot. And I want to start with describing what gross sales actually means, because this is probably the most simple. Gross sales is the entirety of all your sales, including sales tax, comps, and discounts. Most restaurants should be analyzing their financial information and business health off of adjusted net sales, which is also gross minus sales tax. So even though the customer has to pay that sales tax, that's what we call a pass-through expense, which you collect from the customer and pay to the state. When you tell me that your labors are 30%, I should be able to assume that you mean a percent of your adjusted net sales. I do not want you factoring in the sales tax you collect, but I do want you factoring in the sales that have been comped or discounted. This helps you get a true analysis of how you're executing based on those full sales. And this brings us to something else, true net. So we talked about gross, we talked about adjusted net. I also want to mention true net. And this is gross sales minus sales tax minus comps and discounts. To be honest with you, I see this most commonly used for restaurants that need a proof of sales for their lease contract. Maybe your rent's based on a certain percentage of your sales. And once you reach that breaking point of sales, additional rent kicks in. This is when I see true net sales used the most because, to be honest with you, it's the most favorable for the restaurant. And of course, it depends on how your lease contract is written. All right, next thing I want to talk about is MSD groups and where should I stop. So MSD stands for Master Sales Departments, and this is really referring to the different categories you have set up to categorize your sales. So you might have NA Bev, wine, food, bottled beer, draft beer. Depending on your concept, this is going to be a different set of categories. And the answer to how granular you should get depends heavily on your concept. There's not a one-size-fits-all answer here. If non-alcoholic beverages make up 5% of your revenue, do you need to have a specific category for tea, coffee, and other? Probably not. But if you're a coffee place and that makes up 80% of your revenue, you better believe I want you to be able to analyze those costs separately. So with any MSD, Master Sales Department category, ask yourself, is there value in separating these sales out? All right, lastly, as we're talking about sales still, I want to talk about what's top line sales versus other income. So on your P&L, the majority of your revenue should be at the top so that when you're evaluating those costs I was just talking about, you have a solid basis to divide them into, sales basis to divide them into. However, there are some examples of income to your restaurant that you may want to live all the way at the bottom of your P&L and not be included in that sales basis. The most common example I see is when a restaurant sells t-shirts or hats or swag. This is a great business activity. I'm never going to try to talk you out of that. It's free advertising, but does not normally make up large amounts of your revenue. Also, when you're evaluating your operational labor, retail sales should probably not be factoring in. I do not want you writing your service schedule based on how much in retail sales you think you will be selling. Other income should live at the bottom of your P&L and should be separated out. Sydney's going to touch on this a little bit later in the presentation today, but as we're talking about sales, it's an important concept to talk about. Okay, so now for the fun part. We're going to simplify your P&L by pretending like all of your sales are $1. This is a great way to reinforce why evaluating expenses as a percentage of your sales This is a great way to reinforce why evaluating expenses as a percentage of your sales is a great approach. So as we go through, we're going to go through an example today. Think of your sales equaling $1 or 100%, and think of that cost as pennies taken away from the dollar. So Sid, that being said, why don't we get into our example and what's one of the most significant and first expenses we're going to talk about for restaurants?
Yeah, thanks, Brian. So obviously the first areas are going to be your prime cost area. And there's basically two cost categories that make up your prime costs. These are the main operating costs that your managers have the most direct impact on. That first category is going to be your cost of goods or cost of sales, however you want to look at it. And I literally, Brian, I could probably spend an hour talking about cost of goods. And Brian, I think we have.
Guess what? We did, yeah.
We did. So we did have a cost of goods webinar that goes over best practices and takes a much deeper dive into understanding your cost of goods. So we're not going to go into that today, but if you do have any questions or concerns or issues on your cost of goods, check out our webinar that you'll find under education and training on our website. But we want to look at today. So we're talking your first cost expense, so your cost of sales. So in the next example here that we're going to be showing you, you can see here that we have your food cost category. And with all of the specific GLs that make up those expenses in your food cost to give you an overall food cost of 27.69%. And then you see that you have your pour costs broken down as well. So pour costs being all that beer, wine, liquor, bar consumables, etc. So then you'll have percentages of pour costs there. And the combination of the two total, so if I add up my total usage dollars for food costs and my total usage dollars for pour costs, that gives me my total percentage of sales. So you can see here in our example that our cost of sales was 26.97%. Now, the reason why we're going to convert all these percentages over to pennies is to really help you guys see how the percentages, really do kind of add up to break down that dollar. So we started with $1, but we had a 26.97% cost of sales. So that's 27 cents. So we've had that dollar, we're subtracting out 27 cents. So how much we have left is 73 cents. That's what we have remaining of our original dollar. Now, a couple caveats that I do want to mention. Some questions do come up about what should be reflected in food costs and pour costs. The first one being the NA beverage conundrum. Maybe people ask us, should NA beverage be part of food cost or should it be part of pour cost? This is no right or wrong answer. It differs for every type of concept. Mari mentioned it before. If you've got a heavy percentage, maybe you're a bar and you have a really high percentage of beverage sales and non-alcoholic that are going into that, then maybe that you're going to have any beverage cost be a factor out of your pour cost category. But maybe you're a full line restaurant and you've got very minimal non-alcoholic beverage and it's pretty much all part of your food and any beverage sales, then have that be a cost basis part of your food cost. It doesn't really matter where you're going to have it reflected. The main thing is make sure that your any beverage cost percentage is a cost basis of that sale category, going back to what Brian had said about the master sales departments. Now, the other one that comes up with questions on is bar consumables. Remember that for those mixed beverage sales, for those liquor drinks, you are purchasing ingredients like oranges and limes and herbs, etc., that go into those mixed cocktails. So you are going to have a category called bar consumables where those costs for those ingredients will live, and that will be a cost basis of your liquor sales since all those ingredients are going into making those liquor drinks. So those are your main cost of sales categories that makes up your first cost category of your prime costs. So Brian, we've got cost of sales being our very first prime cost expense. What's the second category of our prime cost, which actually has the most impact for restaurants as well on the bottom line?
I was going to say it's a big one, and you may have guessed it. So labor, it's the largest expense for a lot of restaurants. And if we're working off that same P&L that Sid had for cost of goods, let's look at how this labor is broken out. Even though you may have an overall labor target, I always suggest breaking down the operational labor separately within your overall labor. So think of operational labor as the labor restaurant managers have the most control over. This is hourly labor that you can impact through your scheduling, through cutting. The better the manager, a lot of times the better they staff appropriately for what the sales are going to be. The rest of your labor should include salaries, payroll taxes, employee benefits, employee discounts. And now you have another benchmark to look at, total labor. In this example, the total labor for this location is 36.85 cents. So Sydney already took some of that dollar away when we talked about cost of goods. If I now have 36.85, I'm going to round that up to 37. If I have 37 cents more to take away, how much is left of that dollar? Man, that went fast. We're down to 36 cents left. So Sid, as we're talking about labor, obviously that's a huge expense for restaurants. It's a huge thing that not only do they have control on, but they can make an impact on as well. What are some things to think about when you're talking about labor?
Yeah, well, I hope you guys have all noticed that the examples that we're showing are budget versus actual. And obviously anybody that's joined our webinars, how Brian and I are, all about setting up budgets. And the main thing is, really having that budget in place helps you understand exactly what those targeted cost goals should be. And this falls in line with setting up bonus and incentive plans for your managers. And so bonus become a big question for me. A lot of clients like, hey, why isn't bonuses part of my fully burdened labor? Or why are you suggesting that I move it to below the net operating income line under those other expenses? And the reason for this is because if you do have incentive plans for managers, and they are tasked to hitting a certain cost goal, but then they get a bonus and that bonus hits that same cost goal area, then are they being penalized going into that next period of bonus incentive area where they hit a bonus, so now it's going to be even that much harder to gain that next period's bonus because of having that extra expense hit. So there's kind of many reasons why we would recommend bonuses to actually live below net operating income. So it's not really having a major impact on your fully burdened labor, which is what you're targeting your managers to really hit. So that would be a reason why you might consider having bonuses be below the net operating income line. The other question I see come up a lot with expenses that are hitting fully burdened labor are employee discounts. Remember, when you're creating a salary package for your employees, you're bringing them on and you're saying you're making this amount of money, we're covering this amount in medical expenses, you're going to get this much a day in free meals, etc. So those employee comps and discounts, those are actually benefits to the employees, either benefits that you're giving to them, and they are part of your fully burdened labor cost. So all of those discounts and all of those full 100% comps for employees and managers will actually be a factor in your overall labor. So something to keep in mind there when you're building out your budget for your overall labor dollars as well.
I love that you brought that up. And now that we've talked about the two largest expenses, this is another great place to pause and see how your profit is holding up. And this is often called gross profit after prime costs. Your prime costs are the labor and the cost of goods that we just spoke about. So this is your profit only considering those expenses. And this is a great stopping point to evaluate your operators' overall control of the expenses they have the most direct control over. Many restaurants I work with set up the bonus structures that Sydney was just talking about based on a combination of the gross profit and some of the key metrics that managers have impact on. So Sid, that being said, now that we understand prime costs, we understand gross profit, there's still stuff to pay for, right? What are some of those fixed and semi-variable costs that impact our bottom line?
There most definitely is. So there's two more cost categories that managers at the store level still have an impact on and have the ability to, somewhat control. First one being direct operating costs. So you can see here in this example of direct operating that, this is where all of your supply purchases are happening: kitchen supplies, restaurant supplies, soaps and chemicals, linen and dry cleaning, all of those miscellaneous things that the operators need to, really be running operations within the four walls. You want to try and keep this expense, obviously as low as possible. Kind of a standard might be around 5% or 5 pennies to the dollar that you would have in your direct operating costs. But this is something that should be budgeted and managed that the managers do have control over. So I think, Brian, you said we had 37 cents remaining, or 36 cents remaining of gross profit after prime. So we had 36 pennies left of our dollar. Direct operating was 3.56%. I'm just going to round up on that. So we spent 4 more cents of that dollar. So we have 32 cents remaining after our direct operating expenses. But the other one, there's one more significant cost category that managers have control over. What is that, Brian?
Okay, so it's going to be advertising, it's going to be promotions, and I want you to think of that as driving your business. So I actually want to go back to how I described the adjusted net sales at the beginning of the presentation. You'll remember that those sales at the top of your P&L should include comps and discounts. Well, this means that somewhere you have to account for those comps and discounts as an expense. And my suggestion is to account for this with the rest of your advertising costs. So direct advertising costs in this example right here is included with the different comps and discounts. A common way to go through and categorize your comps and discounts is manager repair, which we think of as things that are correcting negative situations within the restaurant and are really good for giving operators feedback on, hey, this is something we want to get better moving forward. And then there's also VIP promo type discounts that are really used to drive business and create regulars. And this really hopefully helps ring true as to why this is categorized as an advertising cost for you. If so, in this example right here, you can see that the actual advertising cost is 4.87%. It's about 5 cents. The dollar's going fast. We're down to 27 cents left. So we're getting pretty lean on what's left in that dollar. But before we go over to the rest of the expenses, I do want to touch on some considerations to be thinking about in your advertising and promotion category.
Yeah, thanks for bringing that up, Brian. So other things that are going to hit advertising, first and foremost, are going to be all those third-party delivery vendors. So, anybody that you're working with as far as DoorDash, Uber Eats, Grubhub, et cetera, all of those fees. This is where we really recommend best practices where those fees hit for all of those third-party vendors that you're using. There are questions that arise. Should they be a factor of food costs, or should it be advertising or some direct operating expense? But if you actually really think what the end use of your third-party vendors are, it's all about driving revenue. When the pandemic hit, we had to be able to get our food into, diners' hands with all of the closures, et cetera. So you were driving revenue. It's about increasing sales. It's about getting brand awareness out there, making sure that you're staying relevant. Those are all advertising type functionalities. So really think about those delivery fees being a factor of your advertising costs. Just like Open Table, those reservations and getting the brand out there, it's an advertising expense. So have those hit advertising. Now, Brian mentioned it. Remember, comps and discounts. The reason why we are giving you, reporting gross sales is because we want your prime cost to have 100% credit of all of your sales. So regardless if you comped and discounted it, you still had to purchase the food, you still had to staff it and make it. So your food cost and your labor cost should have credit for 100% of those sales. But obviously you comped and discounted it. So now we're going to back them out. So again, employee discounts will be coming out of your labor cost. All of your other discounts, like your manager repair, your VIP promo, internal marketing, those hit that advertising expense line. And lastly, Brian mentioned the direct advertising spend. This is something you never want to let up on, even as we're struggling with economy and sales and quarantines and closures, et cetera. You don't ever want to let up on your advertising expenses. And you want to make sure that you're doing some good, hard direct advertising to, really factor into those top line sales. So make sure that this is part of your budget, that not only are you budgeting direct spend, but you also are factoring in the internal marketing that you're doing with those comps and discounts. And 100% of that should be part of that advertising budget. I went long on that, Brian, but I know there's more cost categories. So let's start going through the rest of those fixed expenses.
Yeah, guess what? There's more to pay for still.
Doesn't end.
Okay, so starting with general and administrative expense, this is, business licenses, what you pay for legal fees, accounting fees, things like that. And this is probably a pretty average number for restaurants, the 4.45% here for general and administrative expense. And guess what? Now we're down to less than a quarter left of our dollar, only 23 cents. Next, you still got to think about repairing and maintaining the building. Hopefully that's not a huge expense for you, but still has to be considered because we're accounting for everything. If that's 0.58% in this example, usually it's around 1% in a lot of restaurants. Okay, we're still at 23 cents. We're doing a lot of rounding, so we want to stay accurate here. And then occupancy, huge expense for a lot of restaurants, and especially during the pandemic. Someone sent in a comment I saw, Sydney, while we were talking about sales that said, what sales? Yeah, that's something that everybody has to come to grips with this year, depending on where you are and what kind of limited occupancy, if any, dine-in seating is happening and you're having to pivot. And a lot of times that if you have a fixed expense for your rent, that percentage of your revenue, as your revenue goes down, that percentage creeps really high up. We like to see occupancy under a 10% for restaurants to be successful. And to make that happen, rent needs to be somewhere around a 6 or 7%. For this location, it's about an 8%, which is 8 more pennies, so 8.05% here. Sydney, we're only down to 15 cents left.
Well, 15 cents is kind of a good day for a lot of restaurants, especially right now.
No doubt.
So we've gone through all of our fixed and semi-variable cost categories. So that 15 cents, what's remaining there is your net operating income. This is the total income you have prior to those non-operating expenses, those corporate G&A and higher level overhead items that you might have. So net operating income, we've got 15 cents. Now, some people who would look at this and also kind of could consider net operating income to be EBITDA. So, whatever you have that might be falling below your net operating income line. Now, the important thing is don't consider this as direct cash to your bank because there's still other income and cost categories to account for prior to actually knowing what your true net profit is. And remember, we say it all the time, true net profit doesn't necessarily equal cash as well. So never, fool yourself into thinking that what your bottom line, your true net profit is, doesn't exactly always match up to what your cash flow is. So keep that in mind. But before we go through those last remaining categories, Brian, I think let's go ahead and tee up another poll question.
Let's do it. Let's do another poll question. And the question is, what do you care about the most when it comes to financial reports? I'm going to get that up on your screen right now. All right. And you may say you care the most about accuracy. You may say it's the bottom line. You may say it's your bonus, or you may say, the results keep my boss happy. All right. I see a ton of responses coming in. And I think I see a majority here, but I'm going to give everybody a little bit more time to get it in because I still see a couple answers trickling in.
I'm answering, I want to keep my boss happy.
Yeah, right. All right, I'm going to end the polling. It looks like everybody's had a chance to get their results in. Sid, look at this. They're after our own heart. Accuracy. Overwhelming majority said accuracy here. A lot of people just said the bottom line. That's something you have to come to grips with this year, like we said. And some people are right there with you, Sid. Let's keep my boss happy right now, right?
Well, I couldn't agree with that, more on accuracy. I think it's something that Brian and I talk about a lot. Garbage in is garbage out. Your financial statements are only as good as the information and the data that's going into them. So making sure that every single transaction is being properly recorded, making sure that you're checking your bank activity and making sure every transaction that hits your operating account is being accounted for properly will help give you that financial accuracy that you're looking for. So I love that that's what you're focused on.
I love that answer too, no doubt. Okay, Sid, so we're down to 15 cents and there's still some more things to consider, right?
Oh my gosh, these margins are getting tight. All right. So below net operating income, you're going to have other income. So this is, Brian said at the beginning, we were talking about sales and those top line sales versus what might go into other income. So retail sales, those merchandise sales. Some clients might have room rental. Maybe you have a banquet facility and you charge a room rental fee for renting out that space for a large party, et cetera. All of those different miscellaneous incomes are going to fall into that other income category. So obviously other income might actually help increase, that bottom line net profit. However, for, if you may or may not have retail sales, et cetera, so you may or may not have other income, but that is where that you would be seeing that reported. Now, in addition to that, you'll have other expenses, and everyone will have other expenses below net operating income because that really is where depreciation, amortization, interest expense, taxes, et cetera, that's where you're going to have that risk of those current other expenses. But other expenses that you might have will be owner-related expenses. Owner comp, so owner salaries, other random miscellaneous expense. Bonuses would be where I would have this hit as well. This is where you're going to have those types of expenses that managers do not have any control over. Obviously, it's a factor into the profitability of the business, but we're keeping them below the net operating income because they really don't have any insight into that, any bearing on it. They can't really affect any, changes to that area. So that's why we consider those other expenses. And then obviously the amortization and depreciation adjustments will hit at the year end. So we had 15 cents, but you can see from our example here, 10 cents now were spent on other expenses. So when it's all said and done, what is left of our dollar is now down to 10 cents, 5 cents.
5 cents, yeah.
5 cents. I was like, so that dollar goes really quickly. Yeah, 5 cents left. And, keep in mind, so prime cost, that is the bulk of your dollar. Really the standard is between 60 and 70% makes up of your prime cost. So 60 to 70 cents of every single dollar is your prime cost expense. So you really only have 30 to 40 cents to cover all of your fixed expenses. And if fixed expenses are typically running between 20 and 25%, which, 20 to 25 cents of every dollar, then you can see why our net profit is all the way down to 5 cents. So those pennies add up quickly. So, Brian, I think it's time for our final poll question.
All right, let's do it.
All right.
Understanding the P&L matters to me because it impacts my money. I want the restaurant to be successful, my own personal development, or I can help coach and develop my team. I'm going to get this up on your screen in just 1 second. There we go. And again, I'll read the question again. Understanding the P&L matters to me because it impacts my money. I want the restaurant to be successful, my own personal development, and I can help coach and develop my team.
Well, I think that last one's why we did this one, right?
All right, it's a close race between two. I'm wondering if you can guess which two, Sid.
I want the restaurant to be successful.
You got one.
And impacts my money.
Actually, a lot of people helping to coach and develop their team, which I love. I'm all about training and education, and it's great because the results show that the more you coach and develop your whole team to understand how the P&L works, how they can make an impact on profitability, the more impact they are going to have on that profitability and the better you'll do. So
actually, I think that leads right into our next topic too, right, Brian? I mean, it really is about the manager involvement.
All right. So let's talk about some more best practices. Again, it wouldn't be a Sydney and Brian webinar if we didn't have a good amount of best practices in here. And the first one I want to talk about is the frequency you're reviewing. And this goes back to one of the first poll questions we asked. But the more frequent you're reviewing your financial statements, the better. I'm really a fan of weekly manager meetings to review the weekly P&Ls. This is especially important for the restaurant industry because everything's changing on a dime, especially in 2020, right? Commodity prices are changing, staffing challenges, consumer buying behavior, and are they willing to come into the restaurant right now and dine in, or are you going to pivot to more of a to-go delivery model? You need to be ready to pivot to all of these and adjust your operational practices accordingly.
Yeah, and I think especially now, with opening, going back down to lockdown, opening back up, et cetera, you've got to stay on top of your financial health every single week and be looking at your financial statements weekly to see exactly where you have areas of opportunity to be able to adjust, to be able to help with cash flow, to help with profitability. So the more frequent, the better for sure.
All right, let's also talk about manager and team involvement. And I'm encouraged by the results of the last poll results when I talk about this as well. But everyone, the more you get your team involved, the better. This does not mean the owner is spitting out results to the team every week. Task the managers to compile information and present it to the team. Rotate different managers, let everybody get a shot. The more they're responsible for presenting that information, the better they're going to understand it. And most importantly, it's really going to help them be solution oriented when they're presenting the information as well.
Yeah, I mean, it's all about results driven. solution oriented. I mean, we preach that all the time, but the managers want to be involved. They want to take ownership of it. They want to have full understanding of it so they can, show you that they can review it, react to it, adjust for it, and implement a plan for it. So I think that the more that you involve your managers and help them have a full understanding of your P&L and really show them that, hey, I might do 2 million in top line sales and I made $1,000. Like that is a real thing. And they don't have that perception in their head unless you actually encourage sharing this information with them and having them be participating in it. So definitely get them involved.
All right. Also, and this one will surprise a lot of RSI clients, but I want to talk through this because it's so important. Working off a period-based calendar is a must for restaurants. And again, for RSI clients, this is an automatic. We insist on this because we know how good it is for restaurants, but this presentation is not just for RSI clients. And in the restaurant community, there's plenty of clients who are working off of monthly based financial information. And Sydney and I believe you're doing yourself a disservice by working off a monthly calendar rather than a period-based calendar. Period-based calendars help ensure that you're comparing apples to apples with period or year-over-year comparisons. So again, this is important for restaurants because really, Sid, each period has the same number of Fridays, the same number of Saturdays, the same number of Mondays. These are all sales impacting days, whether it's positive or negative. And it's important with period-based accounting that you're looking at everything the same, right?
100%. And it's not even just about the period. You said it right off, Brian. It's about the week. And you can't do weekly financial statements if you're on a monthly calendar. So by having that weekly financial, you're able to be actually proactive with managing your business versus monthly when you're looking at a financial statement at the end of a full calendar month that maybe is a week after the fact. Like, what are you going to do 6 weeks from the date when that those things were occurring? So being able to really, to what Brian said, the cross comparisons is extremely important. But it also really allows you to be proactively managing your business instead of being reactive after the fact.
All right, let's get to the last section of our best practices. And we've mentioned it a bunch during the whole presentation. I hope you noticed that during the breakdown, we were showing you budget information and actual information. And guess what? That was deliberate. We believe that working off a budget is helpful so that everyone knows where to aim. So a 30% food cost may be good for some restaurants, really bad for other restaurants. It matters on your concept. It matters on your product mix. It matters on your pricing. But I want you to have a budget target in there so that the whole team knows where you want them to fall in terms of financial results.
Love it. And with having that budget in place, you are getting real-time updates, so you can be utilizing it as a declining spending budget as well. So definitely is a good thing to have in place.
All right, Sid. So as we're talking about results, unfortunately, we get a C- for sticking.
Yeah, I think I went way over time. Sorry. I went on a couple tangents, Brian.
Went on a couple tangents. I know we got some good stuff in there. So I saw some good questions come in too. So we're going to try to spend about 4 or 5 minutes covering questions. But like I said, if you got a question in and we don't get to it, because I can tell already that we aren't going to be able to get to every question, we will answer you directly, like I said.
Perfect.
Okay.
What's our first question?
Let's dive in. So Sid, the first one I see, I know that every restaurant is different, but how much money should a restaurant be making? Man, that's a loaded question. Good one.
It is. And it's obviously it's going to be different for every single restaurant, every single type of concept, because obviously margins are different based off of what you're selling, et cetera, and what your overhead might look like. I'd say rule of thumb, you're going to see bottom line profitability. Well, I think I mentioned it earlier. I think your prime costs, on a good day are going to run you about 60 cents on the dollar. Maybe 55 if you're really, really lucky. And then, if you're a full service restaurant that have a lot of, expenses and, high end quality food and a lot of production that goes behind it, then your prime cost might only be 70%, only leaving you 30 cents. So with fixed expenses being at 25, I'd say on a good day, you're looking between 5 to 10, 15%, probably 15 at the highest. For bars and restaurants, they could possibly get as high as 20%. Right now, I think everyone's struggling. So I think those margins are down to like literally 2, 3, 4 cents right now. But I would say rule of thumb, I would say anywhere between 5 and 15%. It really does depend though on what your occupancy is, what your fixed expenses are. I mean, it's just so hard to just say a specific number when there's so many factors that play into it.
Totally depends. And Sid and I actually recommend building out that budget and figuring out for yourself how you can map it out to make a profit, and maybe even making an adjusted budget for 2020 based on all the different expenses and revenue expectations you have now.
Yeah, budgeting for next year is definitely going to be a beast. It's going to be very difficult. I mean, even seasoned professionals that do it for the living are like, don't even really know what to think about what might be happening next year. So stay in there, work off of a very short-term budget, month after month.
All right. The next question I see here is, how can I be sure everything is accounted for? I'll take this one, Sid. So I assume that what we're asking is that all transactions that are affecting your business are being accounted for. You should be doing some kind of bank reconciliation at the end of each accounting term. So maybe monthly, maybe periodly, depending on your accounting. For RSI clients, it's going to be once a period. And we do perform a bank reconciliation for you to make sure every transaction that cleared your bank account is accounted for one way or another. But everyone should be doing some kind of bank rec as well. All right. Sydney, last question. We're going to get real deep into accounting with this one. What's the difference between cash-based accounting and accrual-based accounting? And Sid, I'm even going to add my own sub-question here with that. Which is better for restaurants?
Great question, and we didn't actually even bring it up, so someone's trying to throw a curveball at us. So great question. So cash-based accounting versus accrued accounting. So at RSI, we actually are more focused on accrued accounting. And basically the difference is when a cash-based accounting system is when you are recording the expense at the time that you pay it. So basically that expense and that purchase or whatever, that transaction hits your profit and loss statement the day that you write the check and cut it. That's cash-based accounting. This doesn't help you with really having insight into what happened during a certain time frame, et cetera, if you're just recording the expense at the time that you actually physically cut the check for it. So Brian, in answer to your sub-question on that, we always recommend accrued accounting. The difference with that is that you are recording the expense in the day or the week that it was purchased, when you accounted, when it was actually purchased for. You may not pay it for 30 days. That's why you have terms on vendors. So you will always record the transaction the week that it occurs, the day that it occurs, the sale of the day that it occurs, regardless of when the income comes in, when it gets deposited, or when you actually turn around and cut the check. And that's really the difference between cash-based accounting and accrued accounting. Accrued accounting is what we always recommend for restaurants because you at a certain 30 days from now, but your inventory and your costs and everything are being impacted when you actually make that purchase, regardless of when you pay it. So you want to go with accrued accounting.
Good question. Somebody was trying to stump you.
I know, I kind of got fizzled up there for a minute, but Brian, I think that we are at our time though, unfortunately.
We're over our time. Yeah, out of time is to say the least, but thank you everyone for coming to the presentation today. Thanks for your questions. Thanks for your engagement in the poll questions we had. And you can see our contact information on this slide. If you have any questions that you didn't get a chance to ask and you want to shoot them our way, that's fine. We have client advisors at rsiaccounting.com. And that brings us to the end of our presentation.
Yeah, any questions that we may not have gotten to that you plugged in, we will be responding back to you with those answers. And everyone attended will get a recording of this. So thank you all so much.
Have a great day.